Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. When we talk about building a legacy, we often focus entirely on the accumulation phase, the hard work, the investments, and the strategic planning it takes to build a family kingdom. But true wealth management requires you to look just as closely at the transition phase. And unfortunately, the transition of wealth can be a highly taxable event. Most Americans are vaguely familiar with the federal estate tax, but there is an entirely different, often unexpected local trap known as the death tax. Specifically, I'm talking about the inheritance tax. While the federal government does not levy an inheritance tax, there are a handful of states that still do. And unlike an estate tax, which is paid by the deceased person's estate, the inheritance tax is levied directly on the person who receives the money. Today, we look at states that still enforce this tax, the official difference between the estate and the inheritance tax, and how to structurally shield your heirs so that there's no surprise tax bill. So, in order to protect your wealth, you must first understand the fundamental accounting and legal distinctions between the two types of death taxes. Think of an estate tax as a tax on giving. It's calculated based on the net worth of everything you own at the time of your passing. The tax is paid from the estate itself before any distributions are made. At the federal level, this only kicks in for ultra wealthy estates. Some states still have smaller thresholds, and they also enforce an estate tax. The inheritance tax, on the other hand, is a tax on receiving. It does not care about the total size of the estate. It looks strictly at the specific amount of money that an individual heir receives, where the heir lives, and the biological relationship to the decedent. In the current tax year, there are only 6 states that maintain an active inheritance tax. Those states are Pennsylvania, New Jersey, Maryland, Kentucky, Nebraska, and Iowa. If you live in one of these 6 states or reside in one of these 6 states, you have to give your estate planning some specialized attention, or you can see up to 18% vanish to the state tax when the heirs receive the benefit.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
So the IRS and state tax departments categorize your heirs into 2 distinct classes, and the tax rate changes dramatically depending on which class an heir falls into. In almost every state, Class A beneficiaries, which include surviving spouses, and in many states, direct lineal descendants like children and grandchildren, are completely exempt or face 0% tax rate. These states recognize the importance of preserving immediate family nucleus. But look at what happens when you want to leave your wealth to a Class B or a Class C beneficiary. These include siblings, nieces, nephews, cousins, and non-relative long-life friends. In states like Pennsylvania, leaving money to a sibling triggers an immediate 12% flat tax. Leaving it to a niece or a friend triggers a 15% tax. These are very, very important things to consider. I'm Nathan Weaver, and we'll see you next time.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.